Good morning, you magnificent melon heads, and happy Tuesday, everybody. It is April 4th, 2023. Big story this morning is last night the FDIC announced that they had plans to unload the commercial real estate holdings that was left over from Signature Bank. You may recall Signature Bank, they never actually failed. They did get seized by the FDIC under some little bit suspicious circumstances. Now, there was a deal earlier about mid March to offload some of Signature's resources into New York Community Bank, who agreed to buy them, but noticeably absent was a large chunk of their assets. And I had theorized that it was mostly their commercial real estate. And actually, it wasn't my theory. That's actually what it was. The board for New York Community Bank specifically said that they had not bought any of that commercial real estate. Well, yesterday, the FDIC announced their plans to unload that material. Now, it's not going to happen until this summer, but they're already running into problems. We're going to get into that a little bit. And when the debasement of the currency runs face first into price controls, you end up with this kind of a problem. Elsewhere, we've got Marko Kolanovic over at JP Morgan. He's one of their big stocks analysts. He's saying that this run up and this rally in equities recently is just the calm before the storm. That's significant because Kolanovic is known for being something of an optimist. He was actually bullish for most of last year, even though stocks were selling off. So to see him say something like that is something that we ought to pay attention to. And with that, we are going to shrink my big million of a head and let's see what's going on in stocks this morning. We've got the S&P essentially flat, up 3 points or 0.09%. The Dow is down 6, basically flat, down 0.02% at 33,594. And the NASDAQ, of course, is up 18 points or 0.15% at 12,209. Looking over at the U.S. dollar, the DXY is flat right now at 102.1, up 1 basis point. And moving on into bonds right now, we got something of a muted bond market this morning. We got yields are up generally across the curve. The 10-year yield is at 3.48, up about 5 basis points or 1.5%. And that is the big mover with the exception of the 3-month, which is up 16 basis points at 4.9 right now, up 3.4%. Looking over at commodities, check out gold hovering above 2,000 at 2,005, up $5.85 this morning, 0.3%. Silver is at 24.24, up 22 cents or 0.9% this morning. I like to see the shinies rally. Crude oil at 81.22, up 80 cents this morning or 0.99% as the market continues to digest that unexpected cut in output from the OPEC Plus countries that was announced yesterday or Sunday night. And also natural gas still sitting at $2.10, currently up about a half a cent or 0.19%. Just taking a look at that gold chart, I mentioned a lot about the 2,000 level. Now, we have been hitting our head at this level for several days now. We've struggled to break above it. This is the first time we've spent any significant time at the 2,000 level since really going back to March of last year. We were only there for a day or two before we got smashed right back down. Going back a little bit further when gold was over that 2,000 mark, before that was in August of 2020 when we were up at this level, almost 2,100 for about a week again before getting price smashed down. So what do you guys think? Is this it? Has gold completed this gigantic cup and handle pattern? Are we off to the races? Or is there another price smash coming? Let me know down in the comments what you guys think. Regardless of that, I am always a fan of precious metals because I like to protect my wealth from the eroding effects of inflation and the actions of central bankers. I don't worry too much about the day-to-day swings in price. Moving on, here is the announcement from the FDIC. This came out just yesterday. The FDIC announces upcoming sale of loan portfolio for the former Signature Bank in New York. The FDIC today announced the framework of a marketing process for approximately $60 billion loan portfolio retained in receivership following the failure of Signature Bank. And that's misleading because Signature Bank did not fail. It was seized before it failed. The portfolio is comprised primarily of commercial real estate loans, commercial and smaller pool of single-family residential loans. The CRE loans include a concentration of multifamily properties primarily located in New York City. Now, it's those multifamily properties that are going to be a problem because the majority of these properties, it turns out on Signature's book, are rent-controlled multifamily housing. That's a big deal. There's some very strict rent control laws in New York, especially a law that was passed in 2019, and that made it impossible for landlords to raise rents in these buildings. Well, you may recall that home prices have ballooned in value since 2019 significantly. Funny thing happens when you print trillions of dollars, it flows into assets. So now you've got these buildings that are way, way overpriced, but the landlords who own them are not allowed to raise the rent so that the cash flow can meet the expenses of ownership. Now, on top of that, you've also got the problem of rising rates and that these loans are maturing. CRE loans typically mature every 5 to 10 years. So they're going to have to refinance into higher interest rates, which means the payments on these buildings are about to rise substantially, but the owners or prospective new owners will not be allowed to raise the rents to meet those expenses. So how are you ever going to get somebody to come in and buy these buildings? Well, you're going to have to lower the price, substantially lower the price. Well, if they substantially lower the price on a $60 billion real estate portfolio, what's that going to do to the remainder of real estate in the city? It's going to lower your comparable prices. So New York has a big problem here. They've got the problem of monetary debasement, has ballooned real estate prices. They've got the problem of not enough affordable housing in the city, but then you've got the problem of who's going to come in and buy this stuff if the affordable housing priorities means you can't raise your prices in order to be cash flow positive because of the ballooning values. All of these problems are running face first into each other, and that's why this paragraph is important. The FDIC has a statutory obligation, among other factors, to maximize the preservation of the availability and affordability of residential real property for low and moderate income individuals. The FDIC is currently reviewing the CRE loans secured by multifamily residences that are in rent stabilized or rent controlled, an important source of affordable housing in New York City. For this portion of the portfolio, the FDIC plans to reach out to state and local government agencies as well as community-based organizations to inform them of the FDIC's efforts to seek their input as the FDIC develops its marketing and disposition strategy. So the FDIC is saying, look, guys, we're going to have to let these values crater. If we don't, we have to allow the new landlords to raise the rent. There's no easy answer here, folks. There is just no easy situation. You either let the rents rise to a market value or you let the prices come down to a market value, and you've got competing interests on both sides who don't want to let either of those things happen. And this is the problem that we have. Now, this is also important. The FDIC expects to begin its marketing of the retained loan portfolio later this summer. So it's going to be several months before they even start this process. It's going to take them a long time to find buyers for this stuff. There's going to be a lot of policy. There's going to be a lot of politicking back and forth. This is going to make a mess. They're going to have to take their time and do it slowly. Otherwise, they could really jar something loose in New York's real estate market. Moving on, we've got this note from JP Morgan this morning warning that stocks are in a calm before the storm. The past 2 weeks of inflows were driven by a short squeeze and a fall in the VIX. Equities likely to retest last year's low, according to Marko Kolanovic. A risk-on mood is fueling this year's equities rally and is likely to falter with headwinds from bank turbulence and oil shock and slowing growth poised to send stocks back toward their lows, according to JP Morgan strategist Marko Kolanovic. The Fed indicated no intention to cut interest rates this year, yet risk assets are exhibiting an unprecedented rally, with European stocks trading near all-time highs and U.S. stocks recovering from recent losses. Kalanovic wrote in a note on Monday, we expect a reversal in risk sentiment and the market to retest last year's low over the coming month. And look, coming months, I'm sorry, not coming month. That's an important detail. That S was important. I share Kalanovic's sentiment here. This risk-on behavior, you guys, you've seen my streams recently, and you know where I fall on this one. Watching these stocks go up in the face of bank failures has just been bewildering to me, and sooner or later, this euphoria is going to break. It's going to give way, and look out below when that happens. So that's where we're at this morning, guys. And I got a lot of people to say thank you to this morning. I have seen a lot of color bars streaming past here. Bear with me while we find everybody. Coming up, here we go. Thank you very much, EC660. Sir, I appreciate the super chat and support of the channel. He says, thanks, guys. Now I'm going back under my rock. See you in a few days. Well, Patrick the Starfish, thank you very much, sir, for the support of the channel, for everything you do. Enjoy things under the rock, although I don't know where you guys are at, but here in Pennsylvania, it is beautiful out today. We have got 70 degrees, so I'm going to spend a little bit of time working out in the yard this afternoon because I'm going to enjoy this weather while we have it. And thank you, Mike Binder. Robin RC Model says DXY under 100 by Friday. Suppress oil price is pricey. Wow, under 100 by Friday. That's a pretty substantial call there, Mike. That would be a big move. Let's see, we're at 102. I won't say it's impossible. I mean, two percentage point move in the Dixie. We've seen it in that time frame. That will make a mess of things, though, if we see that big of a move in the dollar. I mean, look, the world is de-dollarizing. I don't think it's happening quite as fast as some people are claiming it's happening, although, every day another story about another trade deal cutting out the U.S. dollar. Can't keep ignoring those headlines. So let's just say I'd be surprised if we saw that under 100 by Friday, but I won't rule it out, Mike. Thank you very much, sir, for the support of the channel, and thank you to Raiden57. He says, who is the AIG of the commercial real estate world? The first name that comes to mind for me is Blackstone. Blackstone has that $60 billion BREIT or BREIT program. That's their fund for wealthy individuals. They have locked their investors inside that fund for 5 consecutive months now, not allowing people to sell. They've been saying that if they allow people to withdraw their money, that they'd be forced to unload their properties. It would devalue the properties. So while their investors are locked inside that fund, we've got things like Signature Bank is going to unload their commercial real estate in New York. We had Silicon Valley Bank's commercial real estate portfolio was just sold off to First Citizens Bank at a big discount of 77 cents on the dollar. I just talked about that yesterday in a video. So if I had to make the call, I'd probably say Blackstone is the leading contender for the title of AIG this time around. Thank you very much, Raiden57. I appreciate the super chat, sir, and the support of the channel. Thank you to KDM. Says, I think they'll use this to force us to stop work from home, force companies to end the policy so they start renting space again and support the rent. KDM, I agree with that to an extent that I do think they're going to try that. I see it starting already. I see a lot of mayors in cities who are leaning on business to try to force companies or entice companies to force their workers back into the office. Now, there's a double-edged sword there, right? You've got these mayors and these politicians, in order to shore up their tax base, maybe they incentivize these companies to force their employees to bring people back into work. And maybe the companies can't resist those incentives or that political pressure. But that's also a perk that may cost those companies talent, because now that these companies have allowed their people a taste of the work-from-home life, it's a pretty sweet gig. Well, if you force people to come back into the office 4.5 or 5 days a week, some of those people are going to leave your company, so it's going to cost you talent. So it's not going to be as easy as just force everybody to come in. I think some companies will do that, and how much it's going to cost them remains to be seen. But I do see that sentiment of get it by force. I do see that shaping up in markets. Thank you very much, KDM, and thank you, Steve Woitis. Says, downtown Toronto, Canada's financial capital, office vacancy rates averaged 16% in Q1 23. Vacancy rates were 3.5% in 2018. That's pretty impressive number, Steve, and I'm seeing things in San Francisco that say even higher. I have seen in the 30s in San Francisco for vacant office properties, and probably something similar in New York. Office space, we have way too much of it. Retail space, we have way too much of it. Housing, we don't have enough. So the solution there seems obvious. There is a reshuffling of all real estate priorities in America that is due. And if the government decides to solve this problem with price controls or with easy money and money printing and lower rates, it's only going to exacerbate those problems. Let the free market find the solution. Thank you very much, Steve Woitis. Appreciate the super chat. Have I gotten everybody? I did get everybody. Apologize if I missed anybody. I did not do that on purpose. It's hard to get all these at the same time. Long story short, oh, there you go. There you go, Lone Star. Sneaking in at the last minute there. There he is. Lone Star Street 8, or Lone Star Straight. There we go. It took me a minute to read that. He says, I own a lawn care company. Vanity businesses, nail and hair salons utilize services weekly in 2021, switched to every 2 weeks in 2022, and going into 23 every 3 weeks. Money is drying up. Wow. So that's interesting to see. They're starting to cut their expenses. That you're probably going to see things like deferred maintenance. If you're deferring maintenance outside in the public-facing part of your business, you're probably deferring maintenance inside the building. So I think that's going to be probably another theme that we see repeating itself. Sorry, Lone Star Straight. I hope it's not taking too big of a chunk out of your business. But we're probably going to see a lot of that. Guys, you probably noticed the strip malls around the country. They're starting to let things go. The flower beds aren't as well maintained. The bushes aren't trimmed, right? You're going to see that when money gets tight, people have to make hard decisions. It's unfortunately a sign of the times. Thank you very much, Lone Star Straight. Appreciate it very much, guys. So long story short, there is a whole bunch of commercial real estate about to hit the market. It's not going to be as easy as just putting it up for sale because right now nobody wants to buy it because they're not allowed to make those buildings cash flow positive. So this is going to be a whole big mess, this Signature Bank unloading. You're going to have politicians, community organizations, real estate brokers, banks, everybody involved. And when all those people get involved in the same deal, well, let's just say, count me out. I want nothing to do with it. Guys, until next time, thank you very much for all the super chats. By the way, I appreciate the support of the channel. Thank you to my Patreon supporters for everything you guys do for the channel. You are awesome. I'll be scheduling our Zoom call for tomorrow. I'll be scheduling that today, so look for that in your feed. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.